all for coming here. We're going to be talking about conditional markets and one of the most exciting applications of conditional markets, which is Futarchy. So my idea is for us to begin maybe in the first 20 minutes talking a bit about what conditional markets are, because everybody here knows about typical markets, but I don't think everybody knows about conditional markets. So what is conditional markets? Okay, so Robin, can you help us? So what are conditional markets and how can conditional markets be used to make decisions?
So imagine you have a project with a deadline. You want to know, will we make the deadline? And you make an asset that pays if you make the deadline, pays $10 if you make the deadline, and then you let people trade that. And if the price is $2 for this asset, you say that's a 20% chance of making the deadline. That would be a straight trade. But you can do called off trades where people trade, but the trade is called off if the condition isn't met. And then when you're estimating what price is it worth in a called off trade, you need to be making a conditional estimate. What's the chance of making the deadline if we change who's in charge, or if we delay the deadline, things like that. So you can implement that true called off trade. So you can just have conditional assets on one side and twice conditional assets on the other side. That is, you trade $1 if we change the deadline for $1 if we change the deadline and make the deadline. And that's giving you a conditional probability. So, and you can do conditional expectations as well as conditional probabilities by having things. So they're straightforward to implement. The reason why you might want them is not only just in general if you want a fuller probability distribution, conditional probabilities are part of a fuller distribution, but the value of markets in general is thought, in decision theory, is thought to be informing decisions, and conditional markets can be right next to a decision. So like in a deadline case, if you're wondering whether to extend the deadline and what chance that will make to making the deadline, you ask the conditional question, you get directly the conditional estimate, and you can compare it, say, to the unconditional estimate and get direct decision advice. So if we're trying to convince people that in fact these markets are relevant for their decision, conditional market right next to a decision is the best I can think of, and I call that a decision market. That's the very quick summary, and of course we can talk about its application to many things, but some people have tried these in the past. You're about to try them now. I'm not sure where you want to go with this.
So I think I want to maybe go a little bit slower regarding for the perspective of a trader or a user, how exactly do I make a trade on a conditional market, and so there is like a traditional way of trading conditional markets, which is the kind of calling off or canceling the market. So yeah, so you can kind of think of the way I like to think about it is I like to think about kind of like different branches of the multiverse. So you can have an event like an election. So right now everybody's talking about elections. So who's going to win the election, right? So you have like one world where say like Trump is going to win the election, and there's another world where Biden wins the election, and you can kind of make different trades, or you can have different probabilities for different things, depending on which world you are in. Right, so I like to think it's this way, and then the two ways you can think about this is one way is okay, maybe all trades you make here get cancelled if this thing doesn't happen. So maybe this is like a Trump winner and this is like Biden winner, or I'm just writing these names like this. You gotta actually, usually you wanna have two conditions. You can have more conditions, of course. But another way you can think about it is actually using the conditional assets as kind of the units for the bets. So you can kind of use the conditional assets to trade here, and then if this doesn't happen, if Biden's going to win, then all the conditional assets are value of this world, the money for this world kind of goes to zero, and then all the assets, all profits and liabilities all go to zero. That's another way to think about this. So I have many more things that I want to talk about this, but maybe maybe do you think we should take a question about like what conditional market is? Has everybody understood how conditional market works? You have a question?
No, I was saying.
All good. All good. You have a question?
Okay, very simple question. How do I put money into a conditional market? Because my current money is not conditional.
Okay. Okay, so I'm going to answer. So in this scenario, one thing you can do, you can have kind of $1, and then you can split your dollar into two conditional dollars. So you can kind of split them into, say, a USD Trump and a USD Biden, right? And this, imagine you only have these two scenarios, or generally just X or not X. And then what you can do is you can, any moment, split money into one of these and one of this, and vice versa. You can also split this and this back to normal dollars. So the way you make a trade on any market conditional on this side of the branch, you first split your money, yes, and then you can use this part. Does that make sense? And then if you make a profit, you're going to be making a profit on this currency, which means that this profit is not really real unless Trump wins. Or loss is also not real because if Biden wins, you're going to still be getting our whole amount of USD Biden conditions. Did that answer? Okay, awesome.
I don't know if I should say it, but I don't want to scare you, but there is a very general, elegant way to think about these things in terms of, a general combinatorial probability and combinatorial prediction markets. So, as you probably know, one way to think about probability or something is to have a set of states of the world instead of all the possibilities. And then each of these conditions you think about is some subset of the set of all possibilities. And in some sense, you could take $1 and turn it into $1 in each state. And then what you're doing is trading some dollars of states for others. And every trade in a combinatorial, you can think of some way in which you're increasing the number of dollars in some states and losing less dollars in other states. And basically, then there's a price for each state. And the probability for every set of states is the sum of the probabilities for the set of states in there. And then the price, that's the price for the state. And then when you make a trade, if you buy some set of states, each of your dollar, if that state goes up, and sell it goes down. And in that sense, what a combinatorial prediction market needs to do is let you trade any set of states for any others under the constraint that wherever your dollars are going down in the states, they're not allowed to go below zero. Otherwise, the system is like giving you free money. And there are actually ways to we actually demonstrated full combinatorial probabilities where we had 1,000 variables in a Bayesian network, and you could go and trade any variable in the network or any connection of the network, and then it would just do a full update of the whole network with exact Bayesian updating and exact updating all your representation of assets and making sure you can never trade stuff you don't have. So that's, you don't have to do that, and there are many interesting applications without going into the full complexity, but I wanted to impress you that it is possible. This was demonstrated and implemented, etc. You can do full combinatorial prediction markets with a full representation of a large state space and actually efficiently compute it all.
So it's not particularly computationally difficult to have what one
Well, it was difficult in the sense that we had to figure out the algorithms and implement them, but as you may know that anytime you have a vast combinatorial space base, in principle, there's a vast number of parameters, so you have to simplify it somehow, and one popular way to simplify that is a Bayesian network. And so there's literature on how to compute a Bayesian network. But with our 1,000 variables, we allowed people to edit which connections the variables had. And so there's just a lot you can do. But the point is, you don't have to go all that way to do very simple things. Just simple conditionals are interesting. So Like, for example, in elections, all sorts of bets are about who's going to win the election. But the socially valuable thing to know about in an election is the consequences of who wins. So what you really like to have is, given Trump or Biden, what's the GDP, what's war deaths, what's lifespan, what's culture, international respect, those things. We could have markets on those with just using conditional trades.
Right. So yeah. So in some sense, like conditional markets are like a two-dimensional version of prediction markets, because you can think of making bets on the two-dimensional joint distribution of probabilities. But as Robin mentioned, there's a way to think of many more dimensions. And he has a nice paper about how you can provide liquidity to a full combinatorial, the full range of combinatorial, and also this by agent thing that you can actually make it bigger networks.
Right. Actually, I gotta brag about this one, which is, imagine you have like 100 variables, and then you subsidize each of the 100 variables to let trading on it. And now you want to subsidize all combinations of these 100 variables, right? 2 to the 100, crazy huge. Well, it turns out the subsidy for the 100 variables is completely sufficient to subsidize all combinations. You have to add no subsidy whatsoever to allow all combinations of the variables.
So I think there's some like pretty beautiful results in your papers, but I think there's like a pretty big UX problem or something around like, how do you actually present this to people? Like, I have enough of a hard time predicting GDP in our world today, but like in two worlds, the Biden wins or Trump wins world. And
my favorite interface is, you see a set of variables. You see like a user interface for a set of variables with a set of probabilities for them. So the simple edit-based interface is, you see a number, if you think it's wrong, move it, change it. And each change corresponds to a bet, but you don't have to know about the details of the bet. You just move the number. Somebody else comes along, moves it back, fine. But the interface is, there's a set of numbers, and you can go move any number you think is wrong. This isn't combinatorial yet, but the simple way to make it combinatorial is, not only can you move any number, you can assume any number. So pick any number in your view, assume that it's whatever value you want, and now everything else you see is conditional on that assumption. And now you can edit any of them again. And you can make several assumptions. So you can see, in this way you can go into the full combinatorial space, editing any number conditional on anything else, and it's always the same interface. It's always the same set of variables. It looks exactly the same. You don't have to see funny lines or anything. You just ask, what are the numbers? Do I believe these numbers? Which ones do I think are wrong? And you can ask that same question conditional on whatever scenario you want to get to. Now, if you made 4 assumptions, we should have a part of the interface that tells you, how far have you drilled down? What's the probability of this assumption? Because if it's only a 1% probability, that means there's only 1% chance this edit you made makes any difference. So you should be a little cautious. But a nice thing about combinatorial thing is, the money, you can go into a 1% scenario and make a bet, and then go to another one and make the bet with the same resources you have. You can go to 100 scenarios and bet on all of them with exactly the same resources. You get to make more bets that move more numbers with the same resources.
So that's kind of the generalization of this, right? And this just very simple. So this is the kind of thing that I'm working on right now. You're just gonna have 2 different scenarios. You can assume just a single binary variable that you can use as an assumption. But it's a generalization of this. If you have like 100 different scenarios, you can kind of use your own single source of money or collateral, and kind of split it into different roles and use each piece to make a different trade.
So the nice thing, many people have noted that there's this long shot bias, where if there's an unlikely thing and you bet on it, then it costs people a lot to bet against you. And so they don't want to use up all that money to bet against you, so you push it farther in your optimistic direction than they can push back. But that's, in some sense, solved by combinatorics. Because with combinatorics, you can use the same money to bet on lots of different topics. And so, for example, if there's a 1% scenario and another 1% and another scenario, basically, if you bet on lots of little scenarios, you end up using up your money like the other side. So you break this asymmetry of the small side and the big side with combinatorics.
But these have to be disjoint scenarios, otherwise you would need
Well,
more.
or you can just bet on one thing conditional on another. So once you make a bet on something, that same money can still be used to bet on other things, as long as you're willing to go in conditional. So this person who had the 98% going against the 2%, he's betting this 98%. Today you think, oh, I've locked in all this money and there's nothing I can do with it. You can no, take that same money and bet on something else, except conditional on this thing you just did.
I kind of think another like fundamental constraint for prediction markets is just being able to take your like mental models, your understanding of the world, and like mapping those out. If you have like a lot more numbers that you have to kind of look at and like make adjustments on, how people like fundamentally are just not going to bet on that many markets.
Right, although their bots could do it for them.
How would such a bot work?
Well, I mean, a simple thing would be like, say you edit some statistical model, and it comes up with a bunch of numbers, and you create a bot that says, go look for differences. Like, go look for the biggest differences between my model and what the markets have, and trade or cut them, right? So you can make a bot that's authorized to look for the maximum best opportunities to cut. So you make your model in terms of variables that make sense to you, and you know, and they have details that you're not paying attention to, but if you trust it enough, you can just authorize it to go bet and support.
One thing that I'm excited about for kind of the medium-term future is not short-term, but the medium-term is maybe, I think we actually talked about this, Robin, a while ago, which is maybe having AIs that can talk to you and kind of suggest to you what kinds of complex trades you are likely to represent the kind of information you think you have. So this is one possibility for how dealing with the complexity of betting on these things. But of course, also like it's hard to get the UIs to work the way we want. It's really hard. So I think we need to move forward. I have a few questions. So I will have one question for you, Austin. So how do you see like? Do you think conditional markets are important, and how do you think they complement prediction markets?
I mean, they are kind of like a subset, maybe, or a superset. They're definitely like very closely related to prediction markets. We did play with, for example, for our U.S. politics dashboard version of conditional markets. I think this might even still be up if you go to the National Markets U.S. politics site. Like, in a world where Trump wins, what happens to these questions? In a world where Biden wins, what happens to these particular questions? And I thought that was kind of like an interesting, I mean, using the same example, this is one that people are thinking a lot about because Trump versus Biden is like basically a coin toss at the moment. It is a thing that people want to know, like what the differences in the world are going to be. So I think it's like kind of promising. But I also think, I don't know, this was kind of like a Futarchy discussion, right? Like one of the like goals of Futarchy was like, okay, well we could have, you know, these markets on like, you know, if Biden, if Trump, what happens to GDP, right? But it feels like the feedback, like I just don't trust you very much, or something like that, right? Like if market says like, you know, 60% chance GDP will go hit this margin, 40% chance for Biden versus Trump, like.
Well, if they're really thin markets, there's hardly any trading. Yeah, you shouldn't trust them very much, right? The question is, how can we make these markets thicker? One way to make the markets thicker is to just subsidize them, but another way is to hope they're manipulated, so that any of these conditional markets that actually made a decision, right? The decision was set to be connected to these markets, then people who wanted to get a decision would go try to manipulate the market, and manipulation adds liquidity to a market, which then makes it thicker and actually more accurate. So we have experimental and theoretical evidence that in fact, when you get people to manipulate a market, it's more accurate.
Robin, I have a question prepared for you for how I was going to ask you later about how manipulators can improve liquidity of markets. That's a paper he has. It's a very insightful paper, and I wanted to ask you about that.
He saw the future.
He saw the future, right? Okay. So I think one thing I wanted to add about conditional markets is you can have conditional prediction markets, but you can also have other kinds of conditional markets. You can have conditional futures, so that's actually what we're working on. So so my company is called Quiver. We are a derivatives exchange. So we don't actually have prediction markets, but we're gonna have like derivatives for like Bitcoin price conditional on two Bitcoin prices. One Bitcoin price if Trump wins, one Bitcoin price if Biden wins. We're actually gonna be launching this next week, and that solves a little bit one of the problems. How can I get liquidity for this? Because there's an arbitrage to be made with the real futures for these assets that are already liquid. So that kind of helps a little bit.
So if you think about a conditional of 4 possibilities, there'd be 4 probabilities that add up to 1, so there's only 3 independent numbers there.
Right.
And if one of these numbers is drawn from the outside from some hit market, then there's really only 2 numbers left.
Right.
And so you really only have to subsidize markets in 2 numbers to get all 4. So that is, if you have say you have Bitcoin if Trump and Bitcoin if Biden, and we already have Bitcoin, well, we have the probability of Trump versus Biden out of those numbers already, right? So,
So there's really only 3 dimensions. So I actually like to represent this dimension here. Also to make the difference of conditional markets more easily noticeable. So you can have one dimension which is like the probability of, say, Trump winning or something. So this is like a classical prediction market kind of thing to bet on. You can have like the normal, like a Bitcoin price, which is the kind of thing you bet on the normal market, the normal futures. And the 3rd dimension is the intuitive way that I think about it is more like the impact dimension. So, which is basically, you can think of the impact like 0 is if you think this doesn't matter really, because many people do think that, hey, it doesn't really matter, the election doesn't really matter for the price of this asset. Or you can think that Trump is good for Bitcoin, or Trump is bad for Bitcoin. So that you have this whole dimension that you can bet on independently of betting on, or it's not actually super easy to make it completely independent, but it's a different dimension that you can bet on. That's yeah. So how much? What time is it right now? I don't have a clock.
3:20.
Before we move on, could you explain one more time, sorry, the 4 numbers and how you ended up with we have Trump versus Biden in this Bitcoin derivatives example?
so there's a Bitcoin price.
Yep.
And then we could get a Bitcoin if Trump price and a Bitcoin if Biden price.
Yeah.
And then the Bitcoin price should be an expected value of those other 2 prices, right? So Bitcoin price should equal probability of Biden times Bitcoin if Biden plus 1 minus probability of Biden times Bitcoin if Trump. So now if we've got 4 variables in this equation, so if we get 3 of them, we can solve for the other one. So the one we could solve for is the probability of Biden.
So let's roll down the equation here. So that's the, assuming only these 2 possibilities, Trump or Biden, that's the equation for not being an arbitrary.
And so in some sense, he's going to have markets on Trump, Bitcoin Trump and Biden Trump, and there will be these other Bitcoin prices, and so he will implicitly have probabilities for all the events that he allows conditional trading.
On the topic of Futarchy,
So we haven't told them what that is though.
Oh, okay.
So I told you there are decision markets where you can do I told you what a deadline and whether you extend the deadline, what's the chance of making the deadline. So that's a general formula for any decision. You have an outcome and you're making a decision about it. So one of my favorite examples is we could do markets on the stock price of a company conditional on firing the CEO and compare that to the stock price now. So we can do lots of, or another favorite example is hiring. If we have a new person we might hire, what employee evaluation would we give them in 2 years conditional on hiring them? That's a great thing. So these are many specific decision markers to advise specific decisions, but in order to inspire people and inspire me, you can think about using this as a form of governance. So, as you know, Congress passes bills. We have laws of the land, and every time they pass a bill, the laws of the land change, and they vote on whether to pass each bill. So you could, instead of having Congress vote on passing each bill, you could have them vote on some overall outcome measure, national welfare of some sort, and then we could have these markets for every proposed bill, estimating national welfare given the bill and estimating national welfare given not the bill, and then you could pass the bills that the market approves. So that would be a form of governance centered around using markets, and you could basically have an auction to decide when each new proposal given is. You could even have an auction fee, but then give them a percentage of the gains because they would have an estimate of the number if the proposal passes. And some firms have actually done this. There's some DAOs that are using this as a governance mechanism in the last year. I believe Kelvin is considering doing something like this for his company. And I will brag, there is a India-based healthcare agency, government healthcare agency, that's been using Futarchy for the last year to make key governance decisions about the healthcare agency, i.e. of outcomes like infant mortality. And they've had 6 proposals where they've evaluated those proposals according to 5 outcomes each, with hundreds of thousands of trade each, where they have then gotten a recommendation to do 5 of the 6 things, and they actually follow the recommendations 4 times. And they're planning on expanding this by a factor of 3 or 10 in the next year, and they have interest in some other countries, whole countries, to adopt this for them. So I'm excited, but I can't tell you who it is because they're a government agency with a contractor that I know, and the agency is very sensitive about anything getting out to the media because Indian elections. And so There we go.
Well, the Indian elections are gone, so maybe that's.
We will see. Maybe we're all like reshuffling and you know, after an election, often in many countries, there's a lot of reshuffling and renegotiating, and nobody wants to do anything until that's all settled.
Right.
Yeah.
So I think my goal of this is kind of to play devil's advocate, where like for a long time I was very
But
like.
at least we explained to them a few
Yeah,
things.
yeah. And I've been very hopeful about the concept of Futarchy or just decision markets scope more narrowly. Like for our own company, Manifold, we have many markets. Like, should we implement this feature? Will this help us get to more like daily active users or something like that? We tried this a lot. The thing I ended up finding was that like in order to like steer a company, you need many bits of information, and a market provides very few bits of information.
Unless it's combinatorial.
Unless we had combinatorial markets, we didn't have those implemented. It was just really hard to like figure out how to use this concept of decision markets to actually navigate the world. I expect you yourself probably don't use many decision markets to like make choices.
Personally.
And so how do we like get to that ultimate vision, I guess, of using prediction markets in a decision market context?
Right, so many people try to do a bespoke artisanal thing, which I don't think works so well. That is, they set up a prediction market and they say, let's have meetings to decide which questions we might feel like this month.
Okay.
And that's just a lot of work, and as you say, it takes a lot of expertise, and I just don't think that works very well. I want to slice it differently. I want to say, let's think about deadline markets or new hire markets. Start a project where you try to do a bunch of deadline markets or a bunch of new hire markets. Try to figure out how to make that work in a bunch of contexts, and then scale it up by getting more clients to do that. That is, show that you can do a particular thing well, and then sell that particular thing. So for most, like, people don't tend to buy engines, right? There's a lot of engines inside stuff you buy, but nobody goes out and buys an engine. You buy a thing with an engine in it, right? Because the things you buy are things that do a thing you want. And so that's the way capitalism typically works, is you have a product that does the thing you want, and you sell it to them in certain terms of showing that it does the thing you want with a track record and a price, etc. And it's up to the producer to have the inside of the product make it work. You don't go sell the insides of products to people. So prediction market is like, it's a mechanism that can help make the thing work, but it's not the product. The product is answering particular questions.
Right.
And
So there's all these different kinds of products that people could build using both prediction markets and some kind of conditional markets. One thing is that we are excited about my company is it answers, I think, your question of how many bits of information can we get out of things. So the markets cannot give many bits of information. That's not what markets are good for. At least not markets that don't have, unless conditional markets. That
Combinatorial.
Combinatorial markets. Combinatorial markets are good for this, but they're a little bit trickier to implement. Like the theory is already Robin actually has like the whole code of how to settle these trades and written in Lisp like from 20 years ago. So that's not much of an excuse on our side to actually using things. We could just like get it and adopt this and so on. But we haven't. Not many people have built these things yet. Regarding like governance of companies, so Robin has a full general vision of Futarchy as a way of government, which is the title of his paper is called "Should We Vote on Values and Bet on Beliefs?" For companies, there is a kind of a shortcut on this that maybe you don't need to vote on the values part, because you can just assume the company is a profit maximizing entity. So this is actually what I'm working on. So I want to explain a little bit how we are planning on building a Futarchy. So the way we are going to be building a Futarchy is we're going to have a kind of a cycle of decision making. I'm going to actually clean this up. So the very first step on each cycle is we're going to be running an auction. Okay, that's better. All right, this one has been messing my hand around. So the very first step is running an auction on the slot to make a proposal. Action to the right. So this is to make a proposal. Okay, so the idea is anybody in the world will be able to participate on this auction we're gonna be using our own token or stock to as the unit to bid on. So it can bid, I'm bidding 10,000 shares or 10,000 shares, and then the winner is gonna be able to make a proposal. So step number 2, you actually have to review the proposal. Right, so let's review. And then step number 3, it's going to be actually the evaluation period. So that's the moment where there's going to be a subsidy on the 2 conditional markets. So we're going to have a conditional market for basically share, conditional on yes, share, conditional on no, and then we're going to be running it like for 6 days probably, and we're going to be checking it. Is yes consistently higher than no? So if so, it's going to pass. If not, this is not going to pass. A question?
Yeah. How do you think about sort of like adversarial questions? Like, you know, will CAT use the money from this market to pay off everyone who voted yes during the private equity shutdown?
Perfect. This is a perfect question. So I have 2 answers for this question. The first answer is actually I'm going to ask Robin to do it because he has a paper on manipulators increasing the accuracy of markets. But let's finish this last part. I think it's important. The last part, when we have these markets and we can actually estimate the conditional price of something conditional on proposal being accepted or not, you can actually calculate the difference, and so you can know like basically the impact. From this you can estimate the impact on price. It can be positive, of course. If it's negative, you're not going to do it. But if it's positive, you can actually quantify how much it is, and you can use that to give a reward. So right now we're actually planning on giving kind of a considerable reward of like 20% of the increase in the market cap of the to whoever made the proposal to begin with. So we actually want to give a kind of good reward so that any monkey in the world can make a proposal. Maybe the proposal is firing Kelvin as the CEO and letting someone else go up. And if that makes the share go up, depending on how much it goes up, the more it goes up, the more the reward is for whoever proposed this to begin with. Question?
When do you measure whether or not it went up and by how much? Or is it continuing?
So what Robin and I have discussed is basically we're gonna do during 6 days. We're gonna have first 2-day period. Then during this first 2-day period, we're gonna be looking at the average price of this and this. If the average price of this is higher than of yes is higher than no, we're gonna have a second 2-day period. And then if for the second 2-day period is also higher, we're gonna move to a third 2-day period. And on the third 2-day period, if it's actually higher, then it's actually approved. And we're using the minimum of these 3 impacts to give the reward. So it's a little bit more.
So the reward results to the predicted difference in the.
Right. The reward is based on the impact.
Actual, whether or not my share.
Yeah, so it's actually like a proportion. It's going to be a proportion of the increase in market cap. Right. So imagine our company's worth 100 million, and it goes up to 110 million because the market expects this proposal to increase our price by 10%. That's actually a 10 million increase in the market cap, and maybe we're gonna give a percentage of this as a reward. In the equity, of course, but.
Sorry, last follow-up. Where does the money come from? Because if it is predicted that now you're going to go from $100 million to $1 billion, you now have to come up with 20% of.
Where's the money coming from? So the money is going to be paid in equity, right? Locked over time. So it's not like you cannot just cash out, of course, because you don't have the money. Right? But equity, we can just print it.
So this whole process, is it continuous? Are you doing like 1 a month, 1 a week?
Continuous, so
anytime somebody
probably
can,
make it like a couple times a week, a month. So it's more. So it's not like actually a substitute for having a CEO or having a management. It's more like on place of a board of directors or in place of a shareholder majority vote. Yeah, so.
A couple comments. Obviously, there are several implementations that have been done, and there's details here. A generic thing about all innovation is always a combination of simple, elegant ideas and messy details. And you don't figure out the messy details without trying stuff. And whoever has the elegant ideas doesn't necessarily good at the messy details. So we just need to try a bunch of these variations and see what problems occur and then deal with it. Which is why you don't want to jump too big an application. You want to go in stages. Bigger and bigger applications to see what goes wrong.
Yeah, Robin and I have been having arguments over the last 2 days because I was trying to make things a bit more complicated. It was hard for simple things to begin with.
I've been trying to implement something like this in a different space, and one of the issues with using equity is that you have to come up with a mission schedule because you're managing the supply of that equity over an indefinite period of time. Whereas you might want to repatriate some of it in the event that part of your actors like drop off or become, you know, not helpful contributors on a go-forward basis. How do you think about managing the supply of equity when there's no like, defined end to the process?
Okay, so the way I think about it is that these rewards, they only happen if there is a proposal that the market estimates has a huge impact. So this is not supposed to happen many, many times. So if this is happening many, many times, then the companies are not actually, the price is not actually rising by 10 times or 20 times or 100 times. Then there's probably some manipulation going on, and then we should talk about, ask Robin, what happens when manipulation or they're trying to change the price? Because this is one of the very classical arguments against Futarchy. Won't just somebody manipulate the prices and then, so I'm gonna ask Robin what happens.
So if anybody is next to a window, can pull it open, because I feel like it's pretty stuck.
Yeah,
Just put it, leave the door open, please.
and then actually, Robin probably has about 15 more minutes.
I'm doing the next event in the main rep park, so I'm supposed to go in.
Cultural drift, right?
Cultural drift.
Right.
Question.
So when you have a combinatorial probability market, you're having a whole lot of small combinations, each of them tending to have a very small chance of happening, right? And you want people to be bound to paying the debt so they don't make a bet and they see it's not looking so good, so they disappear off the system and don't pay.
Right.
So you have to make people hold money in escrow. Don't you run into troubles with if the real rate of return on a safe asset, such as a treasury bond, there's no reason to lock up your money in a low probability, odds, rather than putting it into a treasury bond? How do you get around this problem?
So, in general in betting, many betting marketplaces have you deposit cash and they pay you back in cash.
Yeah.
And then they take the float as part of their profit. So that means you have a disincentive to bet on long-term things or short-term things because of this strategy of how they take the profit. They do this because many users aren't noticing that they're paying this tax on their money.
So we don't do it, by the way. It's important.
So a sensible market, the things you're betting are things that accumulate in value, so they are not things you're wary of holding for the long term. They could be bonds, they could be stock index funds or things like that. And if you took a stock index fund and you sharded it into 1,000 pieces for different states, that there's no problem in holding on to those because they're increasing with value with the underlying asset that you're trading. So an ideal market, you walk in with a stock index fund, you say, here's my deposit, and you walk away with however many stock index fund shares that you win or lost, but you're not afraid to deposit stuff because it's valuable.
Right, so there's this big problem of using things that develop over time as margin, which is that you don't want to hold the positions for long. So yeah, you can just use something that doesn't develop, like stocks.
Well,
Bonds.
stocks can devalue relative to bonds, for example.
Sure.
But at least it's something that you want to hold in your portfolio for a long time. It's something that people usually want to hold in their portfolio. Okay. I'm sorry. I think you. Yes.
So I'm with Cowsheet, like we're a prediction market, so totally sold on the idea, and I went to high school with Kelvin, so I've been hearing about this idea for a long time. My question was whether, and if you, maybe probably Robin, have had any feedback on the prospects of this being legal under US regulation, because I think, as we said before, like, markets are useful in proportion to the amount of money traded, and the way to have the most money traded in them is by making them legal. So I was just curious if there was any feedback you received.
Where I think most of the value lies is advising organizations of their decisions. Most of the people who could usefully advise organizations are in the organizations or connected to it. And for that purpose, it typically works fine for the company to hand people their stake, let them trade and walk away with winnings, and that's not illegal.
Right.
So it's only legal if strangers want to bet with each other and they might lose, but if you get your stake from the organization and then you trade it, that's completely legal. So that's the kind of thing I'm most interested in, so I don't feel very limited by the laws for those things.
it seems like what you're proposing is like a generic way we can run our firms better. And so an activist hedge fund seems like way, like they would want to try it out. Because you can purchase a good stake in a firm, apply this, let it run for 4 years.
But they'll want to see that it works in some trials. So I think the limiting factor is we need more trials.
Oh, yeah.
I mean, so I long ago had this approach. If I said if I had $1 million, I'd do the fire the CEO markets for each of the Fortune 500, and I tracked that for 5 years. I think that would be enough to show that in fact the markets are predicting well. But as you follow the pool of companies who follow the market advice compared to the pool who don't, and see if there's a significant difference in their performance. And that would get news. You'd even get liquidity from the CEOs trying to manipulate their prices. But again, you just need to take some particular application like that and do trials and show that it works and show that you can work out the bugs, and then more people will be willing to follow on. But people are not willing to take your abstract description of a possible mechanism without having worked out the bugs and put a lot of money in.
Yeah,
which they want.
Yeah, so Futarchy is something that is a bit threatening to executives for companies. They feel a bit threatened. Some people have told me, like, why do you want to do it? You're going to put yourself at risk of being fired by the market at any moment. Isn't that scary? And yes, it's a bit scary, but but once that's a cost that you have paid to be able to get really useful proposals from people in an incentive compatible way. And the way we actually envision Futarchy being widely adopted over companies is mostly by the investors pressuring the management do it because it's gonna make the price go up. Yeah. So do it. Yeah. They're not gonna do it like happily, I think. They're gonna go like kicking and screaming, but if you can prove that it's actually more efficient, that the prices actually go up, that like investors actually want to invest money, but they actually want to, okay, I'm putting money on this, but I want you guys to adopt Futarchy, otherwise I'm not gonna put it. Right? It's like a bad governance if you don't have Futarchy. That's how the whole economy is gonna kind of move in this direction.
Just like they all hate poison pills. Right.
Like the investors hate poison pills, sure.
And that's why there are no poison pills. Right.
Right. So like over the last several, like it's really hard because most companies are based on majority voting of shareholders, and majority voting of shareholders is really a complicated way of, and not very efficient. So I don't know how many follow crypto have like Vitalik has like a lot written about how this is bad to have majority voting. Like people who have like 0.1%, 0.1% of a large company is a lot of money, and even those people, they don't really have much of an incentive to actually vote correctly. So Futarchy actually solves this in some sense because you can.
We think speculators, when they look at stock price given poison pill, stock price given not poison pill, which price will they set high?
Right. I think.
Was that hand in the back or?
So I think the CEO example makes sense, but I'm wondering about the smaller examples, like hiring a new person or like a deadline for like a specific team. Like, how do you have like enough kind of bettors in that game such that like, you know, the bad actors actually leads to more liquidity? Because I can just imagine like, oh, it's like a deadline for this team. Someone is like, oh, I'll bet against this and I'll sabotage it.
So most of the financial markets you're aware of are very thick, large markets with a lot of volume involved. And then regulators have gotten in the habit of claiming and assuming that those are the only ones that are valuable. There's no point in having small markets. But in fact, if you want information instead of hedging, very tiny markets can work fine for getting information. So for example, we've had lab experiments where there are 3 people in a session in a market they can trade in, and then only one of them actually trades. And yet, the price at the end of the session is better than the price at the beginning, i.e. information was revealed by one person making one trade against a market maker in a small experimental session. So if your standard is just, can the final price be more informed than the initial price, it's really easy for a small number of people to improve on an initial price. If you said, no, I want it to be like really super accurate, well, maybe that's impossible, right?
And do you still have to incentivize those small markets?
Yes, I mean, each person needs to be incentivized to participate, otherwise they won't.
And then just like how, like is incentivization, like is it a percentage? Like I don't get like how you
Okay,
out?
so the way incentivization works for markets usually is by providing some amount of money to an automatic market maker.
Or a
Robin,
human market maker works. It
or a
doesn't have to
human.
be automatic.
Okay, but Robin is one of the pioneers of automated market makers. They were called market scoring rules.
Right. And people started using the same formula for all the crypto automated market makers, basically.
Right. So just put some money in there, and it's like anybody can trade.
Yeah, just a brief comment. We found that when we allowed businesses to make these private markets, they found it incredibly useful, but they always wanted to pass on LMSR. They always wanted it to be just like, we want the payouts to be really wacky, we want the incentivization to be just show up, right? That's the biggest thing. And then the outcome at the end, if you're really funding it as a public, or as a company, as an internal public, right? Then that's up for the company to decide how much money they're losing by not having good scoring, right?
I presume what happens in those markets is then employees get to brag about their scores, and then there's the reward for bragging about your accuracy score as an additional payout. Otherwise, it's just zero-sum cash. Maybe they'll work.
Yeah, and some of it is bragging like, oh, I made hundreds of dollars in the markets.
Right.
Some of it is like, I was right, that was a horrible bet. I hedged against you.
Right.
And
So that's an additional way to subsidize the market.
Yes.
It's to give prestige for the leaderboard.
Yeah, the social aspect is really, so much more powerful than the precise payouts.
But
Anyway,
there are
just-
more knobs there to turn to get wrong. So
Yeah.
if I'm looking for a simple, robust approach, I say just pay for it.
Yeah.
Something I didn't follow about the proposal that's on the board. Why does it start auctioning to the right to make a proposal as opposed to just like there is a market and like at some regular cadence, like the decision that has like the highest EV is chosen?
So the thing is, it's kind of, at least for us right now, it's really hard to have like thousands and thousands of different proposals running at the same time, and then you have like, it could be done, but because you also have to, it could be done. It could be like anybody makes a proposal and then.
But it is awkward if there are multiple proposals live at the time and they interact. You have to be judging the chance to evaluate one in the context of assuming which other ones will pass or won't. So it's cleaner if you just do them one at a time when we know at this moment this is the current status quo, and if we pass it, it's this, right? So you can see how they might interact and cause it, make it complicated.
But like just complementing, because it's the same liquidity, the same subsidy can be used for all markets simultaneously. Like I think in theory it would be better to just have all the 1,000 proposals all at the same time like this.
Combinatorial market.
Because you can use the same liquidity, or the same subsidy, the same automatic market maker that you would have for the base stock. You can just kind of split the liquidity into the different proposals and just have the same liquidity everywhere. So that would be more efficient. I just a bit more technically complicated.
Well, if you in fact care about the combination, so say you have a product you want to know on each of 10 dimensions how to make the product on those dimensions. You know, you could imagine proposing a particular version of the product, or you can imagine just proposing the combinatorial space of all of them and let people tell you which combinations they like.
So actually, Robbie went a little bit ahead there. I was thinking about that proposal was like moving from thinking of 2 options at a time to think to any options at a time. And Robbie actually was thinking ahead and actually thinking about the 2 to the n options, like how picking the whole combination of proposals all at the same time. I was thinking of only picking one proposal at a time. That would make it even a little bit more complicated.
I mean, we're not to leave in a minute,
Yes,
but I do want to say that, like, for something like Manifest, where their customer isn't somebody trying to make a decision willing to pay a lot, it's customers who want to trade a lot. I think a lot of people who want to bet, it's kind of for fun and for bragging rights, and for that, there's a network effect where they want to coordinate on the same things to bet on, and for that, combinatorics or even conditionals may be more of a problem because they see it, you know, if I bet on this, other people won't know about it or talk about it, and I'm sort of diluting my effort. And they want to have the same, so that's I think why we mostly have betting markets and who will win the election, not as the consequences, because people want to argue about that. And so that, you know, again, the combinatorics and conditionals may not be so good for a market whose main customers is just having fun trading and talking about it.
Okay, so maybe let's have one more question for Robin, and then Robin has to go. He's going to have a speech on cultural drift that I actually want to go as well, but I'm going to say a few more minutes, and I'm going to go later. So one more question for Robin.
Sure. Yeah. We talked both about how in Futarchy specifically, of course, there are these worries about manipulation, but how in principle they just add liquidity and actually make them much better. But then also how even markets with only few participants generally contribute to making having better information. But also, basically, isn't there an inherent tension between the two? Where basically, in like markets with a very limited participation, now maybe the market is not efficient enough that to basically have manipulation not work. So basically, if it's a small team voting on whether to hire someone, maybe there's just not enough rational capital there to basically make it so that manipulation wouldn't work.
Manipulators would be, so say there's 1,000 different markets, and each one is very small. Manipulators would be searching for the ones where there's the most, there's manipulators and then there's people trying to be contrary to manipulators, because that's where the profit is, right? You want to trade against the manipulators. So you would search for those. They wouldn't always find them or catch them, but on average they would. So I still think the markets would on average be more accurate, but the correction factor would just be, weaker, because that you have to first find the mistakes to go fix them. But in some sense, you can just like have automated bots that trade against lots. So for example, as part of the CEO markets, we suspect CEOs would be manipulating to make themselves look better, right? I don't have to go do research to figure out which particular company is doing that. I can just like sell them all. But it's terrible.
But
right?
you limit participation, like you said, for legal reasons, for example, you might have to limit for.
Well, certainly limiting participation can limit the correction to manipulation in that, you need somebody with deep pockets to be able to come in and fix problems. If you don't let deep pockets somebody come in, well, they can't do that.
Right, so if people are more interested in reading a Robbins paper, I'm not sure the name is correct. It's similar to that, like manipulators can improve accuracy of predictions.
Just search for the keyword my name and market manipulation.
Just search for this and the AI, Google AI is smart enough to find out. Okay, thank you very much. Okay, so I'm actually going to stay for 5 more minutes because I don't talk.
Yes. Going to the next section.